All right, let's talk interest rates. We've seen in the latest data that the Fed, apparently they like some of the consumer inflation data that's been coming out. So they are, the case for raising interest rates supposedly is much more positive. And that, of course, is a negative for gold. And we've seen the precious metals, they've declined very sharply, and for the month of September they're obviously situated negatively. So this whole process seems like the media is picking on the precious metal sector, that trying to scare away investors from considering the idea of precious metals. I'm not here to tell you one way or the other. This isn't a forum for investment advice per se. Just wanted to share some thoughts, some ideas to you. And that is, look, the interest rates, this whole debate about, interest rates moving higher or lower, here's the deal. Interest rates, they're going to stay the same. Most likely they're going to continue. The Fed is going to continue their dovish monetary policy. If they do raise rates, I believe it'll largely be symbolic. I say this because the economy simply cannot handle a rate hike. All the data that Janet Yellen, the Federal Reserve Chair, all the data that she's been relying upon, they're all misguided data. They're not in the right context. They're not in the context that everybody believes it to be. For example, the labor market, everybody's talking about how jobs are improving. We know that these are nothing more than Walmart and McDonald's jobs. And you can say that because that same liberal mainstream media that says that the jobs are improving are also complaining that wage growth has been stagnant. Well, if these jobs that have been created are all substantive career type jobs, then wage growth would not be stagnant. It will actually increase. It'll increase pretty significantly if these indeed were the type of jobs that you can build a career upon. No, you can't build a career upon these jobs. These are simply, again, minimum wage Walmart type jobs. So of course, naturally, wage growth will be stagnant long term. So in the labor market, the labor market simply cannot handle a rate hike. Let's look at housing data. I mean, people say, well, this year alone, sales of new family homes have increased, I think, 15%, I believe, somewhere around 12 to 15%. All right, I mean, that's something to be happy about, okay? And in July, the reading on those new home sales, I believe it was like 630,000 units of new family homes sold. Again, a great number. But it also means that if we had such a strong rise year to date, that means that January's data wasn't that great to begin with. Otherwise, you wouldn't see that large spike. Okay? And also, when you look at the long-term housing data, you find that 630,000 units sold, that's pretty average. That's actually below average from the 1960s all the way up to 2010, 2009. I mean, those are very, very average numbers. So, this idea that the housing market has recovered, it's very, very deceptive. What they're saying, what the mainstream liberal media is saying, is that housing has recovered, but it's recovered from the very, very bottom, and now it's risen up. Well, if you rise up from the very, very bottom of the housing market, or of any market, of course, you're going to see these impressive percentage numbers. But when you compare that data to what we have seen in the 60s, in the 70s, in the 80s, in the 90s, that number of 630,000 units is actually very, very average. Like I said before, it's actually below average. So I'm not too impressed by the sudden boost in housing, and neither should you. Then let's look at the broader financial sector. I had a discussion with a loan officer that I know, and I understand that this is anecdotal, but it really points towards this broader theme that we're building here, that the economy simply isn't strong enough to handle a rate hike. He said that he has seen a boom in business, okay? He's been, there's been a lot of transactions that he's been dealing with. But those transactions are for refinancing homes. He said that a strong majority are for refinancing. They are not for taking out a mortgage on a new sale, a new home sale. So what that suggests is that people are looking at those interest rates. The people with money, the people with assets are looking at those low interest rates, and they are reacting to it. And this surge of people with money reacting to this data is what's causing a lot of this rise in broad economic activity. But if you say that you're going to raise interest rates, guess what? You're going to create a deflationary environment. Those people with assets, with wealth, they're going to also see that data and say, hey, now is not the time to start borrowing money. Now's the time to start saving money. Well, guess what? All that economic activity that you've built up with your dovish monetary policy simply evaporates. It just goes back to an equilibrium when you introduce a hawkish monetary policy. You can't take all of the gains of dovishness and then introduce a hawkish policy and then expect that a majority of those gains will still be around when you implement that hawkish policy. Not going to happen. It's a lot of give and take. It's a lot of granular negotiations that must occur. I mean, this is simple economics 101, okay? So, when you consider all these factors, the economy, again, it just cannot handle a rate hike. So I believe that the rhetoric that Janet Yellen is using, the rhetoric that the central bankers around her are deploying, it's a charade, you know? I mean, they're selling you this scam. They're selling you this idea that we're so strong, we are so great. In fact, the opposite is true. In fact, when you look at the real data and you look at it through the proper, accurate context, the economy is actually not that strong. And this is the part that gets to people. It is strong, but it is completely dependent upon that dovish monetary policy. Okay? That's the other alternative here. It is strong, but it is solely dependent or largely dependent on dovishness. You take away that dovish monetary policy. You take away that quantitative easing. Guess what? That momentum that you artificially created through dovish policies, that goes away. And what you're left with are people who are not going to refinance, and what you're also left with are people who are not going to buy homes. Because look, if people weren't buying that many homes when interest rates were at record lows, guess what? When you raise interest rates, it's not like you're going to have a sudden surge of buyers. No, they'll be further incentivized not to buy. Everybody will be incentivized to save their money. That will create a slowing of money velocity. That will create this incentive for everybody to hold on to their currency, hold on to their cash. That will stymie economic and business activity. So this concept that, interest rates that, yeah, we can handle. I mean, this is just, I mean, when you really study the data and you really analyze all the metrics that are coming in, put it into the proper context, I mean, it's just total bull crap. The fact that the economy can handle interest rate hikes, such bull crap. That is the biggest pile of bull crap that I've heard all year. Okay, and we've heard a lot of bull crap in this election cycle. But the fact that the economy is substantive enough, that is robust enough to handle an interest rate hike, oh, come on. Give me a break. Do not be fooled by Janet Yellen and the Federal Reserve.